In 2022, average salaries dropped by 4.5%, which is the biggest fall since records began in 2001. But what if I told you that even if you're on an average salary, there are still ways to get onto the property ladder? It's definitely not easy, especially as affordability falls. Affordability is the amount that mortgage lenders are willing to lend you, and in recent years, house prices have consistently increased while salaries have remained stagnant. However, there is hope, but I'm not going to sit here and mention obvious ways like increase your salary or get a deposit inheritance from family, because otherwise you wouldn't be watching this video, you'd already be sat in your new home. I've come across a few unusual ways that can increase the amount you can borrow on an average salary to get you closer to buying a home. If you don't have family members who can give you cash towards your home, then all is not lost. The joint borrower sole proprietor mortgage allows you to apply for a mortgage with someone who's willing to claim joint legal responsibility for the mortgage payments without having any legal ownership in the property or make payments. The key difference between this and a normal joint mortgage is that not all borrowers will be property owners. So you could have a joint mortgage with up to 4 people, but only your name will be registered on the property title deeds. So you will still be the sole owner of the property. This isn't only limited to your parents, but could also be siblings or even friends. All borrowers have joint responsibility for the mortgage payments, which lowers the risk for lenders. This is ideal when your income is too low to qualify for the level of borrowing that you need. You aren't just limited to one family member either. You could even have up to 4 people on the mortgage. For example, if you have 2 mortgage applicants, you could add 2 more family members to further increase the amount you can borrow, with all 4 incomes being taken into account. But only 2 of the buyers will be the legal owners. This is only compatible with a normal mortgage transaction and can't be combined with any government schemes such as Help to Buy or shared ownership. Although there are less mortgage lenders that support this scheme, there are still over 10 lenders that do, so you still have a variety of choice in the market. Once you have a willing guarantor, the lender will combine both of your incomes for a mortgage. Obviously, you aren't going to get market-leading interest rates, but they'll still be very competitive. Lenders often insist that the buyer lives at the property, and some mortgage providers have an age limit for this scheme where applicants must be no older than 70 at the end of the initial deal term. The great thing about this type of mortgage is that when the initial deal period ends and early repayment charges no longer apply, the sole owner can switch to a mortgage in their name only. So this arrangement doesn't need to be for the full length of the mortgage. With a standard mortgage, it's simple to understand that the longer the mortgage term, the more debt you need to repay. However, the length of the term has a direct impact on your overall affordability. If you have a good mortgage advisor, then they will ensure that you're borrowing an amount that is affordable, meaning that it will be fully paid off by the time that you retire from full-time work. It's normal that you only consider the payments in the initial term period, which is usually between 2 and 5 years, allowing you to borrow as much as possible. This often means that you're not looking at what happens in 20 or 30 years. To improve your overall affordability, it can make sense to apply for a longer term mortgage of up to 40 years, which makes your monthly payments lower. This is also ideal if you expect your income to increase in your career over time, which means you can lower the term when it's time to remortgage, or if you meet a partner, you can add them to the mortgage to reduce your share of the payments. For example, if you borrow £270,000 with a 2.29% interest rate over 25 years, this has an initial monthly payment of £1,182 for the first 24 months. However, if you were to extend the term to 35 years, this would reduce your monthly payments by 21% to £935. A longer term also gives you the flexibility to make more regular overpayments to the debt without being obligated to make higher payments every single month. There are lots of moving parts to buying a home, and you don't have to do this alone. A qualified mortgage broker is basically a financial advisor that specializes in mortgages. It's their job to find you the right mortgage for your budget, and they have expert knowledge to show you the best options available so you can select the best lender and mortgage deal. Most mortgage advisors are free, but you can also save additional money because they will also look beyond the best rate and take any applicable fees into account. It's also not compulsory to use a mortgage advisor, but if you go directly to a lender for your mortgage, you'll be limited to only their deals, which may or may not be the best for you. An independent mortgage broker also offers personal, unbiased advice tailored to your individual needs and aren't tied to a particular mortgage provider. So how do they make housing more affordable? Mortgage brokers cover the whole market, giving you access to more products than if you were to research the market yourself. They look at each lender's offering to give you the most competitive mortgage rates. Your mortgage broker is likely to be connected to a professional network within the sector, so they might even be able to offer you specialist products that aren't available to the general public. There are several banks that are slowly loosening their grip on stress tests and increasing the income multiple to above 4.5 times your salary. But these are often limited to individual salaries of over 75k, which makes it unsuitable for the majority of the population. However, the nationwide helping hand is a mortgage product that hopes to boost more average earning first time buyers onto the housing ladder. It can lend you up to 5.5 times your income with just a 5% deposit. This boosts overall affordability by 20%. Like the name suggests, it gives a helping hand to first time buyers when you take out a fixed rate 5 or 10-year mortgage. It's also available on mortgages with a 95% loan to value, an improvement from the original 90%. For example, it means a first time buyer couple with a joint income of 50,000 could borrow up to 275,000 versus 225,000 they could borrow with a conventional 95% mortgage. This assumes they have no other costs impacting affordability. The interest rates are slightly higher to take into account the higher borrowing, but still remain very competitive. And once the fixed period is completed, you can then remortgage at a better rate depending on the current market. This is a pivotal moment by a traditional bank, as Nationwide continue their efforts to convert generation rent into generation buy by focusing directly on the needs of the average earner. This mortgage product provides a wider appeal compared to other high loan to income ratio mortgages on the market, which are normally reserved for high earners. Getting onto the property ladder is becoming harder than ever, but with a little bit of creativity, it can make it more of a reality for some of you watching.